Thanks so much for attending the Naked Trading webinar. I know a lot of you, a lot of familiar people here. If you've read the book Naked Forex, then you know a bit about how I trade. And what I'm going to show you today, although it fits as a naked trading system, it's completely different to the sort of the normal style of trading that I do. So it's really fun actually, and I've quite enjoyed testing this system. So you won't find this in the Naked Forex book. You won't find this really anywhere except here. This is something that I've been doing recently, I think over the last month, and I'll show you kind of how I do it. I've posted the trades in the forum as well. So I have a private forum here, and we'll post trades in here, and I've been posting these trades in here as well. But it's not something that I've really shared before, and part of the reason why is because I go through a certain vetting process. And a lot of people will ask me, I don't have confidence in my trading. What should I do? And really, to me, it comes down to the process you use for vetting your system. So I'll talk a little bit about that right now because it really does pertain to this system in particular, and I'll show you where this system is. So normally what will happen when a lot of traders actually, what will happen with a lot of traders is they will think, okay, I really like this system, but I'm in a drawdown now, so I need to change the system because the market's changed. Or the market's changed, this system doesn't work anymore, I need to modify it or adopt a new system. That's not how I approach it. Because I use such simple systems, I operate under the assumption that they will experience drawdowns, but because they're so simple, robust systems, they won't break down. So they will continue to work into the future. And that's my approach. I would recommend a book called Anti-Fragile. My podcast partner, actually, who's also a trader at the Two Traders podcast, he recommended this book, and it's a great book. I love the author, Nassim Taleb. If you've read The Black Swan, he also has a book on options. Nassim Taleb's a very interesting thinker and probably one of the most interesting thinkers of our time. And Anti-Fragile is kind of this idea, and it really does pertain to my trading, I believe, in that if you have something that's really simple, it's more likely to last. As things get more complex, there are more reasons or opportunities for it to break down, basically. And that's kind of how I trade. Now, this system is extremely simple, but in some ways it runs counter to all of the other strategies that I use. It still depends on support and resistance because that's my basic philosophy for trading. However, it does so in a completely different way, and I'll show you what I mean by that in a moment. So I'm going to give you guys all of the rules for this system. I'm going to show you how it works. I'll show you how it goes, but I just want to give you a little bit of background on what I do for my system. So like I was saying, a lot of traders, when they run into a drawdown, they'll say things like this. They'll say things like, the market has changed. And there's all kinds of reasons, because of hedge funds, because of algo trading, because of Brexit, because of what the central bank did or whatever. So then they'll say things like, so I must change my system. Again, this is not my philosophy. My philosophy is to anticipate drawdowns, use probabilities to anticipate them and avoid the deep drawdowns that I don't want to experience. And you can use that, you can use statistics to basically anticipate those and avoid those, but that's a completely different webinar. We're not going to talk about that here today. So the markets change, and so I must change my system. And that's not how I do this. What I do is I allow so sometimes people get really bored, or they run into a drawdown and they think, I got to scrap everything and start anew. I don't do that. What I do is I use this process where I'll actually do a few things. The first thing I'll do is I'll go to Forex Tester and I'll triple my account. So I want to triple the account in Forex Tester. All right. If you don't know what Forex Tester is, I actually have a course on Forex Tester. And you can get Forex Tester from my link and save a little bit of money at fxjake.com/tester. And I do get paid like $20 if you go through there, but you'll save I don't know, like 50 or 60 bucks if you use my link, something like that. And I have a course for you if you buy it through my link that will show you how to use it because it's a little bit quirky, but it's a great, it's like a simulator. So it's a great way to get a lot of experience trading without actually losing money. And that's what I'll do first. The next thing I'll do is I'll get a demo account. And again, triple the account. So that's forward testing. So this is back testing in Forex Tester. Then we go forward testing with a demo account. And in both cases, what we want to do is get enough trades under our belt to triple our account and to make sure that we know kind of how it's going to behave in different markets. So some trading systems like trending markets, some trading systems like range-bound markets, some trading systems like volatile markets, some trading systems like quiet markets, you know. There's different things that you have to deal with. Now, the next thing I'll do is I'll run it in a small live account. And again, you guessed it, the goal here is to triple the account. And that's where we're at with this system. So before I'll move to a larger sort of standard size account, I do what I'm doing right now with this system. So let me show you this. This account was just created only for this system. So if you go back here, you'll see, how do we do this? Yeah, okay. So you go back here. It started with about 3,900 bucks. I was trying to get $4,000, and I live in Australia, and this is US dollars. So I was trying to just nail it right on $4,000, but it didn't. It started around, I think 39, 39.35 or whatever this is, 39.38, something like that. So here's all the trades, and what you'll notice here is when you guys can see my screen, right? Yeah. Is it all on there? Okay, sweet. Sweet. Excellent. Okay, cool. What you'll notice is that each trade, there's two different hey Nick, glad to have you here, buddy. Great to see you, Nick. Yeah, so what you'll notice is that there's two different positions. So what happens here is I'll take two positions, and one of them has a 1.25 R target. Everyone here familiar with R? R is just simply a measure of what you are risking. So in this case, you can see the risk here is about, I'm trying to get it right around 80 bucks on this account. So trade number one, which was 80 bucks and 80 bucks, so 160, it lost. This is trade number one. Yeah, this was the first trade that was taken. Yeah, it was taken on July 17th. So I guess this account's been going for about 6 weeks. Yeah. So this one lost $161. So that's about what I was trying to risk. Now you'll notice the next trade here, the pound New Zealand, the first trade it made $114, and the second one it made $405. Now what I was trying to get it is it should have been closer to 100 and 320, but the lot size was a little bit off on that one. But you get the idea. Here's another trade right here. This one made $100, which is what I was trying to get. So 1.25 R. Remember, this position was an $80 risk, and it made 100. Okay, that's exactly what I'm trying to get into. And then this one was basically a break-even result. So once it hits the first target or gets close to the first target, about 75% of the way to target one, which is about 1-to-1 when you look at your reward to risk. So if I have 80 pips of risk, if it goes 80 pips in my favor and it's almost to my 100 pip target, then I'll move it to break even, right? So then what happened is it never hit target 2. It never went 4-to-1 on the second target, and it broke even. Here's another one. This one hit the 1.25 R target 1, and then it hit break even. This one right here, it was just, that's an order. It wasn't a trade. This one right here lost. So both, again, it's around 80 bucks you're going to see here. So that one lost. That was a loser. That was on the pound yen. Here's one that hit target 1, and then that one, and then it's still on actually. So we're waiting for target 2 on that one. So if you go over to the live, you'll see the yen is, so this is the one that's waiting on target 2. If it goes up to or down to the target, it'll hit $320 on that one, right? So that's what that one is. And going through here, can keep going. Here's another one that both trades were a loser. Here's one where it hit target 1 on the Euro Kiwi, and we're still waiting on that one to see if it hits target 2. Same thing here on the Swissy, it hit target 1. We're still waiting to see if it hits hard target 2. Here's a break-even result on the pound CAD. This one's kind of sad because it went really, really close to the first target, so I moved it to break even, and it came back and hit broke even on both positions. So you can see here, that's kind of the philosophy. There's nothing really earth-shattering on that. This idea of moving to break even when the market goes in your favor. And essentially, I have two sort of styles of trading this system. And the volatility of the pair will depend on where the stop placement is. And because we're using R targets and we're not using support resistance at all, we're simply using R targets, the stop placement determines the targets. So let me give you some examples, okay? So this right here is a Kiwi pair. This is the Kiwi US dollar. So it was a buy where this green line is here. Does everyone see that? Yeah, you're pretty familiar with Nevada Trader. So it was a buy down here. It went a little bit of a drawdown, went up. It's right down around break even right now. Now, why did I buy here? Well, the simplicity of this is awesome. And if you have a job, and you'll notice that I have lots of trades going on here. See, look at all these trades are just sitting down here waiting to be triggered. Like there's like tons of them. They're like eggs waiting to hatch. And that's what's cool about this. And I actually haven't gone through all the markets that I could and places in here. And in fact, some of these, there's going to be multiple different orders, like sells and buy orders, depending on what the market does. So you'll notice, like for example, let's see here. On the Euro Kiwi, I have a sell trade, and I've already, on the Euro Kiwi, I think I currently have it's a buy, isn't it? Pretty sure it's a buy, yeah. So I've got a buy trade on the Euro Kiwi here, and we're waiting for that target up there. It already hit target 1, remember, and we're waiting on target 2. But I also have a sell trade. If it gets up here, there's going to be a sell trade. So you can see you can have multiple trades on the same pair, which is pretty cool. So let me get back to the logic of it and show you kind of how I trade this. So we'll use this pair since we're already on here. So you can see the Euro Kiwi was falling. So a lot of trend followers were getting in here and shorting it, right? And I actually bought right here. Now, the reason why I used this spot as a buy is because I noticed that the market had kind of consolidated down there recently. And so that's kind of the whole point of this, is if we get a lot of touches on a support and resistance level, then that's a pretty good level to put an order in. And you'll see that's exactly why I have a sell order up here, is because of all of this activity right there. So does everyone see how the market is just kind of like settled in there, and there's a whole lot of especially this one. There's a whole lot of support here. All these candles are kind of just sitting on support. And so the reason why we call it the first touch belly is because the first time the market, in fact, Nick came up with it, who's a member in our forum. I was just calling it like a first touch trade is basically the first time a market comes to a support resistance area and you just take the trade. But I kind of wait for a candle confirmation on those. And I do that with most of my trades, but this is completely different. You're going in not knowing where, not knowing what's going to happen, not knowing what's going on, and you just kind of take it on blind faith. So sometimes you're going to get stopped out. I mean, it's going to happen, but sometimes it's going to actually be a situation like here on the Euro Kiwi. It looks like you're like had some sort of superhuman abilities to know that the market was going to reverse right there. You know what I mean? Like, it's pretty funny. So that's why I had that buy order, was because the market touched down here. Now this isn't really the perfect looking area of consolidation. I kind of prefer to have even more touches than that. I mean, I know those were 3 touches in a row. I think the Kiwi actually gives us a better example. so you guys can see. This is actually a much better example of what I'm looking for here on the QE. Let me show you. See how the market consolidated right here, guys? See how it hit it, it hit it, it hit it, it hit it, and the line chart will show this very clearly. That's kind of what I'm looking for here. All these touches on that zone. And so I just put the order in down here to buy when it gets down there. And my order was in around 05, I think, or no, 73.15, I believe. That's 73.15. So the market got to 73.15. So far, it's gone as low as 72.90. So it's gone on, 25 pips lower than my entry price, which was at 73.17, I think, actually. Doesn't really matter. The point is the stop loss is 80 pips away. So on a normal standard pair, it has an 80 pip stop. So let's just write down the rules here, okay? Number one, what do? Number one, we find a consolidation at a support and resistance level. So consolidating at support and resistance. Consolidation at support and resistance. Okay? Number two, what do we do next? We wait for the market to move away from that zone. Right? And then what do we do next? What do we do next? Well, place an order at that zone. And I will tell you that the way that I tested this in Forex Tester and the way that I demoed it is I place an order just beyond support and resistance zone. So you're not just looking for any support resistance zone. You're looking for one where you see a lot of consolidation, and you almost, it's almost like you put an order in your platform, and you think, you know what, it might not even touch that. That's kind of the way I look at it. I think, you know what, we may not even touch that order. I kind of want it to barely click in. Now, there have been some near misses and close calls, and there was one on the Aussie, I think, where it didn't trigger. In fact, I know it didn't trigger, and that was kind of sad. And you will get those because it'll just. I think I had one. I don't know. I can't remember now. You can see we had one down here that hasn't been hit, but may get hit. I thought we had one. I don't know. I can't remember now. Maybe it was a different pair. Maybe it was the Aussie yen or something. The point is, I know that some of these are going to not click in, and I'm going to be kicking myself. But it almost always, when you test this, and test it in Forex Tester for yourself, don't take anything that anyone says, like I say or anyone else says, don't even throw it out the window, and then go and test it in Forex Tester for yourself before you see. Because this may be a complete loser for you, right? I have no idea. I'm only saying that if I had a job and I had to go to work, this is the kind of system I would want to trade, because there is basically only one decision point you have, which is, when do I move to break even? In fact, you might even say, I'm not even going to move to break even. I think that's ridiculous, but you might move to break even when the market goes halfway to target one, or you might not move to break even at all. Because there's so many times that the market's going to go 100 pips in your favor and then come back, I think it's crazy not to move to break even when you at least hit target one. And I even like to do it a little bit earlier than that, like I said, if it gets almost to target one. But the point is, don't believe anything I say. Believe what you test for yourself. That's really the only way to get good at this stuff. So, but if I had a job, this is the kind of trading I would do, because it's so easy. You spend a lot of time putting all those orders in, right? But then all you really have to do is make that one decision. You have that one decision point, which is, when do I move to break even? Okay, so you place an order just beyond the zone. So in this case, it was a buy a little bit lower than I thought, was the zone because look, you have a wick here, it goes all the way up there, you have a wick up there. I mean, this was really, if you look at kind of this point here and these wicks here, my order was roughly 15 pips lower than I thought it should be. And it even went lower than that. And that happens quite a bit. So it's just something to keep in mind that you're not always going to, you think you're never going to get clicked in, but you often will. So I would definitely do that. Do you need to buy data for Forex Tester? No, you can get free data, and you can, email me, and I can give you some links to get the data. There's actually links where you can get free data to import it into Forex Tester. And if you're testing like the 4-hour charts, like a system like this, I haven't tested on daily or 8-hour or anything like that. But you don't need to buy data. You can buy it once. They do have a data service where they import your software, but I'm old school. Like I've been using it for I don't know, 9 years or something like that. So almost 10 years, I guess. So I don't really, you know what I mean? Like I'm just use the old version where I actually manually put in data. Maybe I should buy the one where the data comes in. The data comes in for you, but I don't do that. Okay, I had a quick sip of my tea. And we're off to the races. Let's go to the next point here. Number 4. Wait for the market to click in. And I never really, the only time I would change my order is if the market establishes a new level, kind of at a different area, like near my zone, near my order, but slightly different. So like if you're looking at the Aussie, I'll show you a good example of this. So maybe on the Aussie, I would decide to move my order. So see how I've got my order all the way down here at 74.50 or whatever. The reason why, of course, is why. Why do I have my order down there? Because look, all of this consolidation on this zone right there. That's why I have my order down there. Now, let's say that the market sits here and consolidates for another, 5 days and just keeps bouncing, and then goes up and it goes higher. Well, then I might have a new zone, and I might go, okay, well, if it keeps bouncing, keeps slamming into this level, then I might put an order in here. I suppose you could look at this and go, well, you should have had an order in there, Walter, because it was already kind of consolidating, but that's borderline. I suppose I could have, but I didn't, so... Yeah. So that's the kind of thing that might change, and I might leave that order in too down there as well. You know what I mean? So I'd have them both in there. So there's not a whole lot of managing of this stuff. It's really, like I said, the only decision you have is when do I move to break even. So you wait for the market to hit your order, and then finally you just decide when to move to break even. For me, it's about 75% of the way. I use it about 75% of the way. 75% to the target. To target 1, not target 2. Target 2 is just a bonus. Like you're going to hit those once in a while. The most likely result is that you get stopped out completely on both positions, or you hit target 1 and then you get stopped out on target 2. That's going to happen more often than not, right? Those are the things that mostly. And if you go back and look at my test account here, you can see that's exactly what's mostly happened. What you get stopped out both positions, or you hit, well, this one's still actually, the other position's still live, but if you go back here, you'll see, for example, this one. So here is a buy on the yen. It hit the target 1 for $100, and then target 2 got break even. Here's another one, hit target 1 on the Aussie for $100, and then it hit break even. That's pretty standard, guys. Like that's what you're going to see happen. Or you're going to get both of them stopped out, like this one right here. Here's the pound yen. Bam, bam, both of them stopped out. So those are your most. Only occasionally will you hit the jackpot and get the 4-to-1. And I want those to increase my alpha. I want those to really push the account, right? Did you find your entries on the 4-hour? Yep, absolutely. All of these zones are established on the 4-hour. So let's look at some orders here. This is probably going to be very helpful. So let's take a look at some of the orders, right? So we'll go to trade, and I'll show you down here. So let's take, for example, Aussie yen. So you can see at Aussie yen, I've got orders at to sell at 79.20. Aussie yen at 79.20. So let's go in there and see why that's the case. Aussie yen, this is a 4-hour Aussie yen chart at 79.20. So you can see this is why. I think this is the one actually that I was saying that I just barely missed out. Yeah, this was the one. See, I thought we were going to get clicked in here, and then look at that. See, the order was up here. Can everyone see that? The order was up here, and it went right there. It wasn't the Aussie, it was the Aussie yen, yeah. But the reason why so I was kind of bummed because it would have been a 4-to-1. You know what I mean? This would have been if I had moved it a little bit lower, I would have hit 100 pip target down here on this candle, and then the 320 pips. No, not yet. 320 pips would have been down there, but whatever. You'll see the reason why this is a sell order here is because we have consolidation at support. Whoa, 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 whoa. That was not good. Moved the whole thing, didn't I? No, cancel. Insert. I really hate it when MetaTrader does that kind of stuff. You can see what happened right here was I had support there, consolidated support, and then consolidated resistance right there, right? So consolidation of resistance, consolidation of support. It's consolidation on this zone, which is awesome. And the reason we call it first touch belly is, as I said in the book, in the Naked Forex book, support and resistance zones are like beer bellies. You can push into them a little bit. What happens when you accidentally push a beer belly? You go, whoa, and you pull your hand away, right? Like, whoa, I didn't mean to push into your belly. Sorry about that, sir. Well, the same thing happens when it hits these zones. Sometimes it'll push in deep and then go, whoa, sorry, and pull away. And sometimes it'll just barely brush up against it like it did here and then move away. But in this case, I had my order at 79.20 and still do have my order at 79.20 because I thought the zone was roughly 79.05. So it was about 15 pips deeper than I thought it would go. And it turns out I was right. Unfortunately, I was right and it didn't quite get there. So that's an example of why. Does everyone see why there was an order there? That's why, right? And so just like that, I could also have an order down here. I don't, but I could easily put an order down around this area here, right? Because got all these touches down there. And that would be roughly, see how the zone, I would call the zone here about 76.25, but I might actually put my order down here at 76.05 or 76 even. Because I think it might spike down that low, right? So that's another spot. Let's pick a few more. I just want to give you guys a feel for this so you can see kind of, there's nothing magic about it. Is this helpful, seeing these? Here's a sell limit on the CAD at 31.90. CAD's got a sell limit at 31.90. So I'll show you why the CAD has a sell limit up here at 31.90. Well, you can probably see on the chart here, it's a very clear consolidation right there. And that's it. It's as simple as that. So I want to be really clear here. It's not only that it's a support and resistance zone, it's that it's a support and resistance zone that you've clearly identified on your chart, which, you know what, let me change the preferences on this. I don't actually use this chart that often for webinar stuff, so that's why that line is so hard to see, but it should hopefully be easier to see. But see how I've got resistance, support, resistance, resistance. Okay, so I can see that it's a zone over here, and I could probably go back and see this as a zone, further back as well, but it's a consolidation at the zone right here. That's the critical piece of information. So it's not these touches here that are enough. It's that it did this. That's what makes it enough, right? And if you were an astute observer, you would probably say, well, hey, Walter, don't you also have one, down here? And the answer would be probably yes, you could have one there. And in that case, I got to talk about the volatile pairs too. I haven't talked about that. In that case, you probably would have just been able to survive 16 70 pip drawdown because remember I used an 80 pip stop. So the rules here are, I'll put everything out here for you for the stops and the targets. So on normal pairs, it has an 80 pip stop. Okay, what are the normal pairs? Pretty much all the standards like the Euro, Kiwi, Aussie, Swissy, pound. So here, normal pair, yen, pound, Swissy, Euro. Aussie CAD, I would say, is a normal pair. Aussie Swiss, Aussie yen, Aussie Kiwi. Let me see here. I would say the Aussie Kiwi is, I'm pretty sure. Let me just make sure. What the quick and dirty way to see if it's normal or not is to see what the average true range is over the last 14 period. Yeah. So here's a basic rule of thumb that I use. If the average true range for your pair is around 20 to 30 pips over the last 14, so I use an average true range of 14, you don't have to do this. You can just use a rule of thumb and go, look, here's the volatile pairs. Pound New Zealand, pound Aussie, pound yen, pound CAD, Euro Kiwi, Euro Aussie, Euro CAD, and those are the volatile pairs. Euro Kiwi, yeah, I said Euro Kiwi. Those are pretty much the volatile pairs. Otherwise, all the other ones are normal. Okay, you can do that. But the other thing, if you want to use the ATR, and you don't know if the Singapore Swedish kroner is a volatile pair or not, you just want to see, is the average true range of the last 14 4-hour candles around 20 pips, or is it around 40 pips? If it's around 40 pips, it's a volatile pair. If it's around 20 pips, it's a normal pair. Does that make sense? So that's pretty much it. So I'll show you what I mean by that. Now, if you go ahead and look at, like, I'm in the trade on the Euro Kiwi right now, all right? Well, if you look at the Euro Kiwi, the average true range on that, what you'll notice is it's completely different to what we just saw. The Euro Kiwi average true range is going to be 50. Look at that. Okay, so the way I tested this out was in Forex Testers. I go, well, volatile pairs have double the stop placement. Okay, so it's 160 pips. Okay, so if it's a volatile pair like the Euro Kiwi, or the pound CAD, or the pound yen, or the pound Aussie, or the pound Kiwi, then you have a 160 pip stop placement. So that means target 2 is going to be where? Or sorry, target 1. If you're risking 160 pips, you can see here that the order was right here and the stop was down. Oh, the stop's gone because it's at break even now, so I can't show you. But the stop is basically right on 1 pip above the entry. But if it's 160 pips as a stop placement, where's target 1 going to be? Because remember, we're going for 1.25R. So where would target 1 be? This is a test. I'm going to take a sip of tea while I wait for your answers. And then we'll go on. It's 1.25R. Yeah, exactly. It is 200 pips. So you have a stop, 160 pips, and then your 1.25R is 200 pips away. Just like your normal stop, and then your target 1 at 1.25R is going to be 100 pips away. Yeah, so it's simple as that. So exactly. Bingo. So now the 4-to-1 target gets a little bit more aggressive. So in the normal pairs, the 4-to-1 is going to be 320 pips away. So this one goes 640. Okay. So target 2 is 640, which is 4R. Target 2, 640 pips, which is roughly, which is equal to 4R. And that's basically it, guys. So hopefully that makes sense. So in these volatile pairs. So what's going to happen here? Well, we already went 200 pips on the Euro Kiwi quite easily from the entry price. You can see it's gone actually 320 pips. So 200 pips was hit around here. So it hit that last week. And so it's either going to get all the way up to my 640 pip target. And I know this seems like it's far away, but remember, the average true range is 50 pips. So this sucker will move. It will sometimes move like, look at this, boom. It'll just move and move. So the most likely thing is that it will come back down here at some stage and stop me out at break even. But I don't manage it. I don't look at it and go, oh, it's going to stop me out at break even. I better get out now and try and save my skin. This is purely a set and forget system. Like I said, the only question I have is, when do I move to break even? All right, so that's basically it, guys. If you want me to show you more orders so you can see the consolidation zones and things like that, I can. Otherwise, we can go, like, here's one up here. You can see there's a sell limit up here beyond my target. There happens to be a sell limit on the Euro Kiwi, and you can see why. All of this consolidation right there, right? So there you go. Are there any questions about the first touch belly? Target 2 is calculated by default, or do you look at... No, it's default. It's purely 4R. So target 1 is 1.25R, and target 2 is 4R. It has nothing to do with it. Now, you may want to look at that. But see, what I was trying to do here is set a system where it's like an R-based system. You know what I mean? It's an R-based system. One of my students, he trades a similar system that it's completely different to this one. But he was talking about how he was using like an R-based trailing stop. And I thought that was really cool because he was getting better results than I was. So that's kind of what turned me on to this. I thought, oh, that's a good idea. And so I started doing the same thing, and I think it's just good fun to trade a system like that. It's just really fun, to trade something like that. So, and you're not achieving your goals by taking profit early. It's going to be really tempting to. But as long as you test this out, you'll see it doesn't matter if you're up a whole bunch of money. Like, you look at this and you go, I don't even know, it is up right now, right? Yeah, it's up $390, but you go, well, look, the point of this is not to make, $11 on this trade where I was risking, $160. The point of this is to see how many of these you can milk out to that 4R on target 2. That's the whole point. So, yeah. Yeah, it's really kind of an R-based thing. So, like, if you're looking at this from a purely support and resistance point of view, you might look at this and go, Walter, that's crazy that you have your target all the way up here because, look, it has to break through that. And that's true. But I'm not doing anything other than trying to maximize my average winner. Now, if it's a break-even result, I don't count that as a winner or a loser. I count that as a trade that never happened, even if it's a small winner or a small loss. And I always do that. That's the way I've always looked at it. And so by getting my winners, all of my losers I know are going to be 80 pips or 160 pips. And then my winners are going to be huge, like 4, or they're just going to be, a little bit greater than the risk was on for that trade. So what happens here, if you have one, let's say you have one winning trade and then the second position stops out of break even. So you make $100 here and then nothing on the second one. And then you have a loser, you'll lose 160, so you're down 60. So what this first target do is just kind of blunts those losers that you have a little bit. You know what I mean? It doesn't quite take out all of the loss, but you could probably inch this up a bit. Your win rate will suffer. You could move it out a little bit further to 150. If you did 150. Then you'd be making, instead of 100, in this case, it'd be 120, right? So you'd be making 120 on that trade, and then let's say you get break even on this one, and then the next one is a loser, so you lose 160, so you only lose 40. You could play around with that. I haven't done that. I've just stuck to this scenario. What's your position size? So the way I'm risking these is based on an $8,000 account. So it's got $4,000 in there. So what I do, guys, is I don't. So my test accounts are all $8,000, And what I do is I'll give my broker $4,000, but because I've got whatever it is, 500 to 1 leverage or something crazy like that, I don't give my broker all of the money, right? So, and I've always kind of operated that way because as we've seen with brokers that go bust, you can't really depend on your broker being able to give you all your money back. So if you're looking at it that way, it's $160 on 8,000, right? So that's 2%, right? Because I'm taking two positions, each of them is a 1% position. So 1% and 1%, so that 2% of $8,000 is $160. Does that make sense, Dia? Yeah. That's essentially what I do. But again, like I said, I only give the broker half the money. The reason, and I always do that, even with standard accounts, and the only reason, so I've set aside $8,000 to test this, but I would never give my broker all the money because I don't need to. I'm not going to be running like crazy, The most I've seen on this, testing it, is, you can see right now I've got 1, 2, 3, 4 positions on. The most I've seen is like, 7 or 8 that you might have on. Sometimes it'll get closer to, maybe 9 or something. I don't think I've ever actually had 10 positions on at the same time. So if I expand and go into more currency pairs, I could probably do that. But so yeah, so I always kind of, because we have such high leverage, I always kind of just hold that money back and don't give your broker all of your trading money. And I suggest that you do that as well. Even finding different brokers. So let's say that you're trading 4 different systems. You might have 4 different brokers. I encourage people to do that too, because if you have all of your money at one broker, all 4 of your accounts at one broker, and then he goes bust, well, bye bye. And we've seen some really big brokers over the years get into trouble, haven't we? So yeah, not naming any names. No names named at all. So do you guys have any more questions about the system or anything like that? Anything else? I can look at some other charts if you'd like. Any live charts that you want to look at, we can certainly do that as well. It's up to you. Live examples of this system or something different? This system? Yeah, sure. Well, I've got the 4. I've shown you the 4, right? The yen was a buy. Wait, hang on. The yen was a sell. Sorry. No, hang on. Yeah, the yen was a sell. Right. The yen was a sell. Right, here it is. Here it is. So the yen had a sell because of this consolidation right here. And also had some consolidation right here. Sorry, I was getting mixed up because I had a buy on the yen recently as well in this system. Now, so this was the first time that the yen got up there. And to be honest, look at these candles. You don't have any reason to short it. Like if you were just looking at this from a naked point of view, I was almost convinced, like for certain, that when I got clicked in on this candle, I thought this is going to be a big fat loser. In fact, a few other trades got clicked down at the same time. I think this is actually non-farm payroll, wasn't it? Yeah, it was. And it was on the back of the non-farm payroll. So that brings up a good point. I don't not trade it. Like I don't turn it off because there's an interest rate announcement or something like that. Because when I tested it in Forex Tester, I didn't do that either. So, and I also, like my normal systems, I won't trade on Monday or Friday, but I love it when these trades get triggered on a Friday or a Monday, because remember what we're saying here. We're saying that the market's gone a little bit too far. It's just touched a zone and it's going to turn around. So we're not actually waiting for that confirmation candle. And if you look at this candle, this is a very bullish candle. And I thought, wow, this sucks that I got triggered on non-farm payroll. This is going to be a big fat loser. And guess what happened? It just completely ate through that candle. And by this candle happens, and I thought, oh, well, okay, we're going to come good here. And even this was a little bit of a hint that it went this far and then kind of did this thing. It's a very downward bearish thing. And I thought it was going to go like this and then fall and hit my target 2. But it didn't. It's already hit target 1 and we're waiting on target 2 down here. So this was a pretty sweet trade. Let me show you I already showed you the Swissy, I think. Swissy was because of, no, I didn't. Because of this level. So look at all of this consolidation here. The more candles on the zone, the better. Look at all of those candles. Okay, let's see. And then it just bounced like a wicked bounce right there. That was so sweet. Consolidation around the pound around. Okay, we'll take a look. You said 31.20. 31.20. 31.20. Is that right here? I think this is what you're talking about. I have it a little bit lower. For the pound, I would probably put it, yeah, I would probably put it right here. I put it a little bit lower than that, probably around the 30, like 80 or something. Here. Yeah, this is one I would definitely be interested in. We just have to make sure, though, that it's a real zone, like historically, and it is. Look at that. Bam, bam, boom, boom. Oh, this is actually beautiful. Look at this. Look at this. That's even better. Yeah. Now, ideally, I will say that ideally, first touch belly, the first touch trade is when you trade this when it's the first time the market comes back to that level. So in that case, it was support here, and the first time it comes back and hits it as resistance, it would have actually been right here. So the first touch trade, which is a different trade, would have been triggered here on this big fat bearish candle, and then you would have been able to sell it off of that. So you would have been able to sell somewhere around here with a stop loss up here, and then your target, I don't know if you would have made maybe a break-even result or maybe a little bit of profit was available on that one, but that's a typical first touch trade. So, however, you also have this consolidation here. So I would definitely say yes, and my order would be, I would actually probably put it around 30.60 to be honest with you. Yeah. And it would have a 80 pip stop, so that would put your stop down at 29.80. Right? That's how I would do that one. So just to, again, it's the pound, so it's a normal pair. So I would buy, and I'll put this order in right after this webinar. I would buy at 30.60, stop loss at 29.80, so that's 80 pips away. And then where's my target? 31.60. So it's going to be right. 31.60 would be right around here. Right around there. Right here. And then I'd move to break even when it hits, say, 31.40, 31.30, around that area. I would move to break even. And then target 2 would be at 33.80. That's 320 pips away. And 33.80 would be right about there, right here. That would be the second target. Okay? Does that make sense? Yeah. You've nailed it. That's exactly the kind of zone I'd be looking for. See, it's easy stuff. Again, don't take my word for it, guys. Do this on your own. Trade it. How do you decide whether to go long or short? Oh, great question. It's just where the market is. Ideally, what would happen? I mean, again, the traditional first touch trade is that you see the market create support, and then it breaks through that, and then it comes back up in its resistance. Do you know what I mean? So traditionally, that's what you do. Is that you look for a support level, and then you wait for it to break through that support, so you'll have a sell trade. And likewise, the opposite would be you look for resistance, and then when it breaks through the resistance, you wait for it to come back down and you find support there. But in this case, it wouldn't be. So I don't really hold hard and fast to those rules. So, but if you want to be really strict, what you would do is you would find support, consolidation on support, and you would look for a sell trade because it'd have to break through that support and come back up there and find resistance, and vice versa, right? You'd look for resistance and you'd want it to break through that resistance and come back down there and find support. So there you go. Does that make sense? It's pretty simple, guys. I would encourage you to go get into ForexTester, get your hands dirty, change the rules around a little bit to make sense for you. I really like the idea of having the 4-to-1 target to increase my average winner. that's what I found that really made sense, over the long run, with testing this. I didn't even worry about support and resistance on the targets. I just said, look, it's either going to blow through and get to my target 2 at 4-1 or it's not. So, yeah. All right. Well, thanks so much, guys. I really appreciate your time at the webinar. I hope to see you, soon or whatever. If you have any questions or whatever, you can always email me. No problems. WP@FXJake. Thanks, guys. Have a wonderful week. See ya. Take care. Happy trading. I'm glad it was very, very helpful. Great comments, guys. Thanks so much. I love to hear that. I really appreciate that. I'm glad. Thanks a lot. Take care. Bye. See ya. Bye.